Imagine checking your retirement portfolio and seeing red across the board. Now imagine watching silver prices climb while everything else stumbles. That feeling of relief, maybe even a little excitement, is exactly what smart money is counting on right now. But here is the problem. That same market signal that made people wealthy during the last silver run is flashing again. And the last time this happened, most investors completely missed it until it was too late. You are about to see exactly what that signal is, why it matters for your retirement, and what the wealthy are quietly doing about it right now. If you are new to OG John Hub, this channel focuses on helping Americans understand retirement, Social Security, Medicare, investing, and personal finance in plain English. No complicated jargon, no get-rich-quick nonsense, just straightforward guidance for people who want to protect what they have built. If you enjoy straightforward retirement and money guidance, subscribe to OG John Hub and turn on notifications so you never miss important updates. Let me take you back to early 2020. Most people remember lockdowns, empty streets, and the stock market dropping faster than anything since 2008. But something else happened during those chaotic weeks. A specific market relationship broke. The ratio between gold and silver, which historically stayed within a certain range, exploded to levels not seen in thousands of years. Not decades, thousands of years. Silver became historically cheap compared to gold. And what happened next? Silver went on a run that rewarded anyone who paid attention. That same ratio is flashing warning signs again today. The gold to silver ratio is simply how many ounces of silver it takes to buy 1 ounce of gold. For most of modern history, that number hovered somewhere between 40 and 60. When the ratio climbs above 80, silver is considered extremely cheap relative to gold. When it drops below 40, silver is considered expensive. Right now, according to publicly available information, that ratio has been climbing back toward levels that historically preceded major moves in silver prices. The last time we saw this setup, silver prices increased significantly over the following months. But here is what most people do not understand. The ratio itself is not the signal. The real signal is what happens after the ratio peaks and begins to reverse. And this is where things become interesting. Most retail investors see a high ratio and immediately buy silver. That seems logical, right? Buy low, sell high. But the smart money, the institutions, and large physical holders, they wait for confirmation. They wait for the ratio to stall. They wait for the first signs of a trend change. And that is exactly what appears to be happening based on current market behavior. Consider a hypothetical example. Imagine 2 retirees, both age 67, both with similar portfolios. One sees the ratio climbing and jumps in immediately, buying silver at what looks like a bargain. The other watches and waits, studying the same historical patterns that have played out for over a century. When the ratio finally stalls and shows the first technical signals of a reversal, the second retiree enters the market at nearly the same price but with much lower risk. Who made the smarter move? The patient one. Because chasing a falling ratio is like trying to catch a falling knife. You might get lucky, or you might get cut. The relationship between gold and silver tells us something deeper about the economy. When investors feel confident, they put money into stocks, real estate, and growth assets. When confidence erodes, they seek safety. Gold is the ultimate safe haven. Silver is different. Silver has industrial uses in solar panels, electric vehicles, medical devices, and electronics. So when the economy slows, silver demand from industry drops. But here is the twist. When investors finally realize that central banks and governments are going to flood the system with liquidity to fix the slowdown, both gold and silver tend to benefit. Silver usually benefits more because it starts from a cheaper base. But the story does not take a straight line, and this is where many retirees make a mistake that costs them real money. They hear that silver might go up, so they buy exchange-traded products, speculative mining stocks, or worse, leveraged ETFs that promise double or triple the return. Then the market takes a breath, silver pulls back 5 or 10%, and suddenly those leveraged products are down 20 or 30%. Panic sets in. They sell at the worst possible moment. The smart money is not using leverage. The smart money is not gambling. The smart money is accumulating physical metal or well-managed funds with low expenses and holding for the longer move. Current rules generally indicate that holding physical precious metals inside an IRA is possible, but comes with specific requirements. The metal must meet purity standards. It must be stored with an approved custodian. You cannot take personal possession while it remains inside the retirement account. This is not a loophole. This is not hidden knowledge. This is simply how the rules are written, and yet every market cycle, people lose money because they misunderstand these basic guidelines. Official guidance should always be verified with a qualified custodian or tax professional before making any move. The emotional side of this is just as important as the technical side. Fear and greed drive markets in the short term. Right now, fear is driving a lot of decisions. Inflation has cooled from its peak, but prices are still higher than they were a few years ago. Social Security cost of living adjustments have helped, but they do not fully close the gap for many retirees. Medicare premiums have also increased, so when people see a potential opportunity in silver, they feel pressure to act immediately. That pressure is exactly what creates opportunity for patient investors, the ones who wait for confirmation, who size their positions appropriately, who understand that no single asset class should dominate a retirement portfolio. Those are the people who sleep well at night. Let me tell you what the historical data actually shows. Going back to the 1970s, every major silver rally has been preceded by an extreme reading in the gold to silver ratio. The ratio peaked above 90 in the late 1970s before silver climbed to its all-time high in 1980. It peaked above 90 again in the early 1990s before a multi-year silver advance. It hit 123 in early 2020 before silver doubled in less than 6 months. According to publicly available information, the ratio has recently been trading in ranges that historically have marked major turning points. But here is the detail most people miss. The ratio can stay extreme for months. It can even get more extreme before it reverses. Trying to time the exact top of the ratio is impossible. What matters is being prepared when the turn finally comes. The real issue appears when investors confuse preparation with action. Preparation means learning about the market, understanding the historical context, deciding on position sizing, and setting up the accounts or storage needed to execute. Action means actually buying. The smart money prepares when the ratio is high. They act when the ratio confirms the reversal. Everyone else acts when the ratio is high, and then panics when it stays high longer than expected. Do you see the difference? If you are retired or close to retirement, your primary goal is not to get rich from a silver rally. Your primary goal is to protect your purchasing power and maintain your standard of living. Silver, like gold, has historically served as a hedge against currency debasement and inflation. It has also been volatile. A well-balanced portfolio for someone age 50 plus might include a small allocation to precious metals, but that allocation should be measured in single-digit percentages, not double digits. The wealthy understand this. They are not betting the farm on silver. They are buying insurance. They are diversifying. They are reducing the risk that any single economic outcome destroys their retirement. What happened next surprised many people during the last cycle. After the ratio peaked in 2020, silver prices moved higher, but they did not move in a straight line. There were sharp pullbacks. There were weeks of sideways trading. There were moments when it looked like the whole thesis was wrong, and those moments shook out the weak hands. The people who understood the longer-term history, who had studied previous cycles, who had sized their positions appropriately, they held on, and they were rewarded. The people who bought because they saw a YouTube video or a headline and expected immediate results, many of them sold at a loss. Do not let that be you. One of the most overlooked aspects of this entire topic is the role of central banks. According to publicly available information, central banks around the world have been buying gold at a record pace in recent years. They are not buying because they expect to get rich. They are buying because they want to diversify away from dollar-denominated assets. Silver does not receive the same level of central bank attention, but it benefits from the same macro environment. When central banks signal that fiat currencies are not as safe as they used to be, hard assets like gold and silver tend to attract capital. This is not a conspiracy. This is not a secret. This is public information available in central bank reports and international monetary data. So where does that leave you today? You have a choice. You can ignore what the market is signaling and hope that traditional stocks and bonds continue to provide the returns you need. Or you can pay attention, do your own research, and make thoughtful adjustments to your portfolio. The smart money is not selling everything and buying silver. The smart money is rebalancing, trimming some overvalued positions, and adding modest exposure to assets that have historically performed well during periods of monetary uncertainty. That is the model you should follow. If you decide that a small allocation to silver makes sense for your situation, Here is how to approach it without making costly mistakes. First, decide whether you want physical metal or paper exposure. Physical metal gives you direct ownership, but requires storage and insurance. Paper exposure through exchange-traded funds is easier, but introduces counterparty risk. Neither is objectively better. The right answer depends on your personal circumstances, your risk tolerance, and your long-term goals. Second, size your position appropriately. For most retirees, a total precious metals allocation of 5 to 15% is reasonable. Third, do not chase. Set a plan, execute slowly, add on pullbacks. And fourth, be patient. The signal is flashing. That does not mean the move happens tomorrow. It could take months, it could take a year. Smart money is patient. You should be too. Thank you for spending time with us here on OG John Hub. If you found this helpful, leave a comment below and share it with someone who may benefit from it. Have you ever owned silver or gold as part of your retirement strategy? What is your age, and how are you thinking about protecting your savings against unexpected market moves? Share your experience in the comments. Your story might help someone else make a better decision. Take care of yourself, take care of your family, and remember that the best retirement plan is the one you actually understand.